Welcome to the Training and Advisory Services online course. In this course, our thrust will be on International Public Sector Accounting Standards (IPSAS) versus International Financial Reporting Standards (IFRS). What will we cover in this course? We'll look at background to IPSAS, differences between IPSAS and IFRS, transitioning from IPSAS to IFRS, and IPSAS implementation. As a background to the International Public Sector Accounting Standards. The International Financial Reporting Standards for the public sector. These standards were tailor-made specifically for public sector. They comprise of 39 approved standards covering the accrual basis and one cash basis standard which focus on the public sector. The standards are issued by the International Public Sector Accounting Standards Board, IPSAS B. That board operates under the International Federation of Accountants, IFAC. Now, the IPSAS are designed to apply to public sector entities that meet all the following criteria. 1. Are responsible for the delivery of services to benefit the public and/or to redistribute income and wealth. 2. Mainly finance their activities directly or indirectly by means of taxes and/or transfers from other levels of government, social contributions, debt, or fees, and do not have a primary objective to make profits. Here is a question to try and help you to apply the criteria specified in the previous slide. Which entities are eligible for IPSAS? Is it PAAB, Zinara, ZESA, RBZ, University of Zimbabwe, or Marondera Rural District Council? In your own time, please go through this and try and determine which ones would need to apply IPSAS. IPSAS applies to central government, urban councils, rural district councils, agencies and authorities, boards, commissions, as well as funds. However, companies and corporations such as ZESA and Tier 1, state hospitals, universities, as well as financial institutions would not need to apply IPSAS and would rather apply IFRS. Let us look at the differences between IPSAS and IFRS, other than the glaring difference of IPSAS being tailor-made for the public sector and IFRS being more for the private sector. IPSAS and IFRS are siblings, and IPSAS standards are largely based on the principles of IFRS. And to ensure greater comparability between private and public sector reporting and accounting for similar types of transactions, we have considered the transaction-neutral approach. Now, IFRSs are more for profit-oriented entities, and IPSAS are for public sector entities. Now, the differences between the two reporting frameworks stem primarily from the following three sources. Changes made by the IPSAS B when developing an equivalent IPSAS based on an IFRS to reflect differences between the public and private sectors. Differences in the range of topics covered by the two sets of standards because of differences in the prevalence of particular types of transactions such as non-exchange transactions, and differences in the timing of when new or amended requirements are introduced into each set. Let us now consider the process of setting IPSAS standards. The IPSAS B first considers the equivalent IFRS. If there is an IFRS standard that covers a similar concept or the same concept, then that will be considered first. From there, the IPSAS board standard setting process considers public sector specific requirements through sector focused research. After that, a due process is followed through public consultation by the use of exposure drafts, and then after comment letters have been received, the board issues an IPSAS. The key principle in developing IPSAS is the transaction-neutral approach. It states that if the transaction is the same in private and public sector, then the accounting should be the same. Now, the public sector is different, and its key characteristics are the volume and significance of non-exchange transactions such as taxes and transfers or the provision of goods and services in a non-market environment. So the volume and significance of non-exchange transactions is greater in the public sector as opposed to the private sector. The importance of a budget within the public sector, because the entities are expected to deliver certain services to the public, the budget becomes very key. Nature of PPE: to provide goods or services and not cash generation, which is often very specific in nature. The responsibility for heritage entrusted upon the public sector entities, the longevity of public sector entities, regulatory role of government, ownership or control of rights to natural resources, and statistical reporting.